Time for Business. Yuka joins us once again. Donald Trump's tariff actions sows confusion and chaos. He's just said he'd probably reconsider his decision to double the planned import duties on Canada. And this just hours after announcing it.
Yeah, it's just another example of how much things can change in a day. The tone down came after the Premier of the Canadian province of Ontario made a U-turn on his action and suspended a 25% surcharge on electricity going to 3 US states. President Trump's trade advisor, Peter Navarro, explaining to CNBC that cooler heads prevailed. Now, earlier on Tuesday, the US president announced a plan to slap a further 25% tariff on Canadian steel and aluminium, bringing the total to 50%. The decision, he said, was in response to Ontario's electricity tax decision, which itself was taken in retaliation to Trump's original 25% across-the-board tariffs. The US president also threatened to shut down the automobile manufacturing business in Canada, causing the big three US automakers' stocks to tumble. The US dollar also dropped sharply against the euro. Now, Ontario's Premier, Doug Ford, initially doubled down on the electricity tax plan, and the incoming Canadian Prime Minister, Mark Carney, also vowed to hit back with maximum impact. But since then, Ford backtracked on his threat, revealing that the US Commerce Secretary, Howard Lutnick, had reached out to him. He'll fly to Washington on Thursday with Federal Finance Minister Dominic LeBlanc to discuss a renewed North American trade deal ahead of the April the 2nd deadline on reciprocal tariffs that Donald Trump has threatened to impose on all trading partners. Wall Street stocks swung wildly today, a day after Monday's heavy sell-off. All three main indexes slid more than 1% in late morning trade, then rebounded after Ontario backed off from a planned electricity surcharge and Ukraine said it was willing to accept a US-brokered ceasefire with Russia. But then they came back down, back under pressure, closing the day in the red across the board, as you can see there on Wall Street.
Now, Trump tariffs are also adding uncertainty to the future of one Asian car maker, Nissan, announcing a management reshuffle to try to stay afloat.
Well, the Japanese carmaker has announced that Ivan Espinosa, the Mexican-born chief planning officer, to replace Makoto Uchida as CEO next month. He'll be Nissan's fourth leader in 8 years. The iconic Japanese carmaker has been facing problems for years, ever since Carlos Ghosn's financial mismanagement scandal led to an overhaul of its alliance, a long-time alliance with Renault. It badly needs a new partnership, but recently merger talks with Honda fell apart amid a clash of corporate cultures. Luke Schrago takes a closer look.
Coming out swinging before he starts his job next month, it's Nissan's new chief executive, Ivan Espinosa, replacing Makoto Uchida.
I sincerely believe that Nissan has so much more potential than what we are seeing today. I'm looking forward to build on the efforts of those who have come before me and working closely with our talented team worldwide to bring stability and growth back to the company.
Nissan desperately needs to find a way to boost its flagging sales. The Japanese firm announced 9,000 job cuts last year and is projecting a nearly €500 million loss for the fiscal year through to the end of March, a situation worsened by the collapse of talks in February for a potential merger with rival Honda, which would have provided the embattled carmaker with a badly needed lifeline. Competition from China hasn't helped either. All automakers have struggled in the face of robust growth in the Chinese electric vehicle sector, but Nissan more than most. The firm that brought out the Leaf EV back in 2010 failed to capitalize on its early success. It didn't develop newer hybrids or other EVs, and lost out badly as the rest of its lineup of models aged. One of the main challenges ahead for Nissan, in the short term at least, will be the burgeoning global trade war. Around a third of the million vehicles it sold in the United States last year were manufactured in Mexico, now under threat of tariffs on just such shipments.
Europe's top car maker is also struggling with falling sales and profits. Tell us more.
Volkswagen is reportedly planning to lay off 1,600 staff at its CARIAD software unit, according to a German business daily. The news coming just as the carmaker published its annual financial results for 2024. Revenue came in at 324 billion euros and operating profit fell 15% from the previous year, partly due to higher production costs and exceptional restructuring costs. Like other European carmakers, Volkswagen is trying to produce more affordable electric cars to catch up with Chinese rivals. CEO Oliver Blume said the auto group's new strategy to focus more on tech and innovation would guide it through an increasingly challenging environment with uncertainty over Donald Trump's tariff war.
Nothing is on the table at the moment. You have to take everything into account. It's not just the goods, it's also the digital flow of goods from the USA to Europe. Some of it goes. And then we will enter into direct dialogue with them and put forward our arguments.